Hi everyone, this is me Vritvi and welcome back to Vritvi Talks the Ambition podcast. With the current market and the whole geopolitical scenario going on right now, I am sure we all are a little worried with our investment decisions and we don't know what is the best step to take forward. And especially if you're a startup founder, and for that matter, all startup founders might be having some different tangent of understandings and misconceptions right now. If yes, then today's episode is for you. My today's guest is Mr. Shashank Randev, an entrepreneur, of course, who believes in scaling up startups with seed capital. He is a founder VC and a co-founder at 100x.vc, a $20 million early stage fund investing in startups using the iSafe notes. 100x.vc has an investment portfolio of around 161 startups from Fund 1 and 2 since 2019. Mr. Shashank has also been a founding member at the VCC Edge, famously now known as the VC Circle. People in the entrepreneurial circuit might be well aware of this name. I am sure that after watching this episode, you all will be enlightened with some basics of the capital market, clearing the air about where and how to move forward. Ladies and gentlemen, please welcome Mr. Shashank Randev. What does he do that I think he should be the best person to tell? So yeah, over to you, Mr. Shashank. Welcome.
Thank you for having me. I'm super excited to be here. We've been coordinating for quite some time and looking forward to our interaction. Very quick background in terms of what I do. I'm one of the co-founders for 100x.vc. We are an early stage fund. We've invested in more than 150 plus companies across India. And prior to this, I had some experience in building a startup. I was one of the founding members for a company called VCC Circle, which got acquired by News Corporation, and that gave me a vantage point of understanding the VC ecosystem from 2009 till date. I love working with early stage founders. I love understanding newer technologies, newer trends which are emerging, and I think it's a great place to be in right now in 2024 when India is just at the cusp of the next phase.
Yeah. Okay. So tell us, Mr. Shashank, what is it that after 150 plus investments, right, since last 5-6 years, right, what is that one thing that actually interests you whenever you meet some new founders or some new founding companies?
When you're interacting with early stage founders or you're in the business of investing, one thing which stands out is the passion and the zeal to continue leading when you fail, right? So pulling up your socks, folding your sleeves, and then going out again, trying to build something. I think that trait is fascinating to me personally because I've been an operator, startup founder, a co-founder, founding team member, and then doing investments, right? So operator, investor gives me a great vantage point. So when I'm talking to founders, I seek out that experience because that helps me understand that the founders will, continue to kind of push on, even in the most tough times. And because startup culture is an ambiguous one. You launch an idea, you don't know if the product will work, the market will adopt it. So I think the most fascinating thing about this process is getting to discover that type of founder. And then obviously having discovered or identified the founding team, figuring out the total addressable opportunity, the business model, the moat which the business model has, and then taking it to a place where you can create more value, add more value, and then hoping that it turns out to be a 20x return or a 30x return or a 50x return, right? And I think that process in discovering newer opportunities, newer trends, which are adding or creating opportunities or solving a large problem within a country like India is a very interesting place to be in, and that really excites me.
That's lovely, yeah. I mean, the way you have explained it pretty much sums it all. But tell me one thing, like if I were a VC, I would have always looked out if the product is, or the business, or whatever the product that they are making or pitching into us, if it's in the correct space with the market, like what we call the product market fit. So how do you guys come in and how do you guys help in to these guys, or is there any advice that you chip in to them and then they're you get the whole thing correct, right?
Sure.
Because I heard in one of your interviews that a lot of young founders rather, right, they are more interested into, oh, मेरी company का valuation इतना होना चाहिए, मेरा valuation उतना होना चाहिए, right? But and to which you had also replied that valuation छोड़ो, पहले वो तो देखो कि product कितना market fit है, right? So how do you kind of
Sure.
help with that?
So, the reason why we started 100x was we realized there was an opportunity at the bottom of the pyramid where there were many good founders, great businesses / products which needed enough capital so that they can start creating more value, right? Now, when you have something which is a little above an idea and you have a product, it is not selling in the market, but it has a great market opportunity and the founders are willing to push. You cannot assign a valuation, right? So how do you then fund these kind of projects / early stage company? And that's where 100x came in, where we decided not to value companies at this stage because it's not correct.
It's not fair.
It's not fair.
Yeah.
You need to kind of create value in order to get valued, right? And our objective was, can we introduce a system or a process or a document or an instrument which is iSafe, India's simple agreement for future equity, which enables giving capital upfront, 1.25 crores, and assigning a value at the future. Whoever comes in at the next round is when the value will be decided. Let's focus on building, right? So once we've invested in a set of companies, we start working very closely with the founders. We'll work with them on their product. We'll work with them on their GTM. If it's a D2C brand, can we enable distribution channels? Right? If you're making a chips brand, we are an early investor in Kerala banana chips, right? So when we invested in them, we figured out how can we enable them to grow a certain X metric over the next 3-4 months. And if there is value to be created by us in that process, that's where we put our heads down. After investing in them, right? And that's the mindset one needs to have when you're operating such a fund, right? And hence, valuation is not important at our stage. Valuation is important at a Series A, because then you need to be assured that there is enough value creation, right? But ours is a different business. Ours is in terms of identifying the high potential companies, working very, very closely with them by deploying capital, not assigning a valuation then, creating steps and processes where value can be created in terms of increasing the sales of let's say Kerala banana chips brand selling 2 lakh rupees, which when we invest in them today they're doing 2 crores a month, right? We recently invested in a company called Up Coffee. In fact, it's been 6 or 8 months. And they've, in the last 8 months, they've raised 5.5 million cumulatively. They have more than 35 stores right now between Bombay and Delhi. And they sell coffee in a grab and go model. Fascinating model, right? So the primary focus for us is ensure that our capital is utilized. We are able to get to that X metric, and their ability to raise the follow-on funding. See, the whole objective of the fund is we want to be a discovery fund for any follow-on investors to come look at companies which are qualified to receive their capital. They're growing at that pace that they need the next level of firepower, and that's where we come in. So hence value creation is at the crux of it and the most important element for us.
Just for our viewers, if at all you could explain, because I want it to be very basic and educative in this podcast. I want you to explain first what exactly is a venture capital. And something which you just rightly just now you said that you want to be like a discovery fund.
Correct.
Right? So these two terms, if at all you could explain.
Sure. So venture capital, it's a process which started in Silicon Valley in 1960s, where a group of innovators, technologists, futurists came together and they started financing, investing. Folks who are wanting to set up something. And the first, I think, venture capital fund or form of venture capital was in a semiconductor company, right, back in Silicon Valley. And the whole premise of venture capital is investing in companies which are just about starting and attempting to build innovative products.
Okay.
Whether it's clean technology, whether it's computers, whether it's semiconductors, and that's how the process started. So in India, venture capital started coming in sometime around 2002, 2003, 2006, and we
when
started.
Silicon Valley was booming.
Correct.
Yeah.
And that's when we first saw private equity funds coming.
Yeah.
And then we saw venture capital funds coming in, and we saw a lot of innovation happening around that in terms of how they're deploying capital, in terms of the kind of opportunities which were emerging in India, right? So VCs are nothing but a form of capital to back outlandish, innovative, disruptive, tech-enabled or non-tech businesses.
Okay.
And these businesses can be started by second-time entrepreneurs or first-time entrepreneurs fresh out of college. That's the pure definition of venture capital, right? From our vantage point, a discovery fund means that a place where you can discover good portfolio companies.
Okay.
So we've invested in 150 plus companies, and the reason why we are saying we want to be the de facto discovery fund is because all my 150 companies should be discoverable and funded by follow-on investors like the Sequoias, Axel, right? And which is the case. We've invested $12.5 million in 150 plus companies over the last 4.5 years, and these companies have raised 80 million USD in follow-on capital, out of which 70% has come through growth stage VCs like Sequoia, Chirate, right? So hence, it's become a discovery fund where you could be a healthcare focused fund.
Yeah.
You can come to 100x and look at 100x portfolio company. You might be a FMCG focused fund. You can come to 100x and look at our portfolio companies. You can be a clean tech fund and you can come to 100x and look at our portfolio companies, right? So
Got it.
that's the process of a discovery fund. And that only works if the companies are high growth and growing. You could be building the best technology in the world, but if you're not growing, if you're not building a business, you're madly in love with your product.
Yeah.
Then you will. Then the whole discovery fund process doesn't work, right? So the process of us coming in and ensuring that the founders continue to build a business and not fall in a product which is may or may not work, but building skill sets to pivot and reiterate the product, I think that's where we come in.
Okay.
Yeah.
Okay. Another one basic question I would like to ask you is, what is the big difference, or maybe it could be a minuscule difference also, but what is the difference between a venture capitalist coming in and an entrepreneur or a founding company seeking funds from a bank? What is the difference over here, and why should one look out for a venture capitalist?
Yeah, so I think venture capital is an expensive form of capital. Bank is cheaper, that's where it stops.
Yeah.
Bank will give you capital, but maybe not the mentoring, the access, the steps to grow. That's where venture capital comes in, right? You take money, but you're also getting their expertise, their ability to open doors. And you might be building a SaaS platform, how you can raise money. And if it's let's say I'm a fund based in India, in Bombay, I've invested in a SaaS company. I know 4 or 5 clients in Bangalore and Delhi, and this company has only one customer. The ability to grow, take our capital, and also our ability to open doors so that they get placed in these companies and they're able to generate contract value. That value creation process is very important, which is what venture capitalists bring
it to, yes.
Right?
So you're saying that network in a VC helps much more than just seeking a fund from a bank.
Correct. Network, market expansion, distribution, and funds like us who are very involved in our portfolio companies, just always ensuring course correction happen. Because at the end of the day, it's money. Founders get excited. They're young founders. So how do you ensure compliances, regulatory issues, which are not known to founders, but how do you build a company structurally for first-time founders? I think that value creation process comes in with VCs, which may or may not come, and I think it doesn't come with bank money. Banks have been a form of funding for, let's say, MSMEs or SMEs, right? And where people know they've built a company and there are assets to show.
Yeah.
But startups don't necessarily have assets. anything to show, right? So that's the difference between venture capital and the bank.
Correct. Okay. Now, while we're speaking so much about venture capital and funds and stuff, right? So, I'll tell you what happens is a lot of people either they start and fail soon and then they're lost. Okay. When we speak about startups around, right? A lot of people in their mid 30s, after a great career in their job sector, they think about starting up and then they kind of kill that thought only because they are scared, or maybe they have lack of knowledge about
Sure.
VCs, like, or maybe they don't even know that where and whom to approach.
Sure.
What would you advise to these people, and how can you pitch it over here?
I think more than approaching anybody, and if that is the deterrent to kind of kickstart a business, I think that's wrong, because that is secondary. I think what is the most important element is that when you want to start something and start a startup, what is the problem you've identified? How big is that problem? What is your solution for it? And is it in an area which is blue ocean,
Okay.
which is there are no players in the
Expand.
market,
Yeah. Okay.
not red ocean, which is competitive, right? Once you've done these 2-3 things, then your courage to build and your conviction, your confidence that you can build out something, these things need to be achieved before you start identifying which investor to pitch, right? Because you are confident about this. This is what we read into.
Yeah.
And you've built something or you've started developing something by breaking your own FD. That shows confidence and faith in what you envision.
Yeah.
If we see that in you, we get convinced, right? But if you have to show us that I need your money to build this out, I'm not too sure if I can build this out, that doesn't work for anybody, right?
Correct.
So that conviction and faith is what needs to be inherent when people are starting out. And if that is not coming, that needs to be there.
Understood.
If you're not, it's not that, okay, I'm not sure if I'm gonna do this. Let me go out and see if there are VCs and let
Yeah.
me pitch my idea. It doesn't work
Exactly.
like that.
See, that's
You
my-
start studying a problem first.
Yeah.
It's not which VC will back any random idea.
Yeah.
Are you passionate about that problem? Have you figured out a solution? Have you figured out a path that this is a large opportunity which I can capture, and I've started working towards it. I've broken some FDs and built the product by myself.
Yeah.
Okay, I've gotten 10 customers. I need 100 customers. Maybe now is the time I can go and pitch, right? That mindset is very important to have, right? And I think once you have that mindset, the courage comes.
Yeah.
Right? That is the only sure shot way of doing entrepreneurship. If you think it's going to be a 9-to-5 job, then please
no.
don't get into
No.
it. Please don't
Then
get
it's a
into it.
strict no.
Yeah.
Yeah. No, because even we get it, right? Because we are into entrepreneurship and we get it. It's not a 9-to-5, guys. It's a 24/7
Yeah.
thing to do. Right. So, Mr. Shashank, we have been speaking so much about, venture capital and Silicon Valley, as you mentioned. I really want to know your thoughts about how closer are we as a country to becoming the next Silicon Valley, or we are already there, or is there more work to be done?
So, in my view, I think we are there.
Mm-hmm.
I think it's a function of how much effort and hard work we're willing to put in. Because Silicon Valley, as an example, should be given understanding the context of Silicon Valley. I think in 1960s, 1950s, the ability to put in the hard work
Yeah.
is what Silicon Valley was known for. That's point number one. Point number two was not shying away from failing
Hmm.
and then coming back and trying something. That culture of failing, that's okay. If you tried again, wow, you've tried again after failing,
Yeah.
amazing. Not being judged. You failed. Arey, yeah, this guy failed, right? That has changed. India has also now reached it's taken in pride. Your family is accepting that you're starting a startup, and if you fail, you try again. That's become a cultural norm, right? So the cultural tonality is there.
Mm-hmm.
Second is we've got second-time entrepreneurs. Second-time entrepreneurs are building out businesses. The second evolution is come into picture. We've seen the first phase end with the Zomatos, with the Flipkarts, with the Olas, right? We've seen value creation happen within India based on these startups which were built out, right?
Yeah.
So the next wave is even more exciting with now the government supporting so many, the government grants coming in. There was recently a startup Mahakumbh which was held.
Yeah.
These are all examples and incidences which you should look at from where Silicon Valley was in 1940s. So the tone has been set. We are here at the right time, in the right place. The real question is, are we willing to
become one or
become an entrepreneur and put in the hard work and understand the opportunity? Because that's the only trait which made Silicon Valley become Silicon Valley. And I think we're getting there. We have a lot of founders who have that mindset. They understand that I'll take some less salary, but there's value to be created. There's an opportunity to make money also besides the products which we are offering.
Yeah.
And India has dime a dozen problems. We have enough solutions to provide. It is the most digitally connected country in the world.
Yes.
And the most populated. So with these kind of metrics, it is the perfect thriving ground to, if you put in, there's this saying that, if it's a bad time, no matter how much you do, 100% effort, aapka result 1% aega. India's time is good.
Yes.
You do 50% and you can, there the opportunities to see 100% result. That's how big the opportunity in India. So we are very much in the spot like Silicon Valley was 1940s, 50s, with the government support, with number of investors, VCs wanting to invest in early stage companies. Most importantly, early stage companies building out solutions, products which have potential to get funded. I think these three channels, when they come together, and with the ability of the culture sitting in that, failing is alright, let's keep doing, let's keep building. That mindset, I think, is going to drive the next few years, and we are there. It's just a function of how much hard work we are willing to put in as investors, as the government, and as entrepreneurs.
Okay. So we spoke about Silicon Valley and entrepreneurship and stuff like that, right? Tell me one thing. Do you think that this sudden wave of entrepreneurship has got something to do because of Shark Tank? Did Shark Tank played a great role over here? Do you think so?
I think Shark Tank has played a role of catalyst in terms of promoting entrepreneurship. And I think entrepreneurship and venture capital and investors investing in businesses has been happening for now close to 20 years in India, and has been largely been prevalent in cities like which are tier 1, Bombay, Bangalore, Delhi, Chennai to some extent, right? I think what Shark Tank did was created an awareness of, if you're building any business in any sphere, there is a potential for you, to get selected, to showcase your products. Most importantly, second, get feedback also, right? To a tier 2, tier 3 and tier 4 city, where usually we might have a difficult time going and, showcasing that. So two things I think Shark Tank has achieved, and I think it is also a function of being digitally connected
I was going to
as a country now. That Shark Tank also has been able to reach that hinterland, and then tier 3 individual has become curious to understand what is entrepreneurship. Can I build something out? And then they start seeking out. Otherwise, if they are digitally connected, they'll go watch a movie trailer or they'll seek out something else. Nobody would organically search for a VC. Now they started asking, what is a VC? Oh, they invest in businesses if I'm building something. So how do I build a business which gets their attention? Now that is the right set of questioning. And I think Shark Tank has enabled that process, right? Many of our portfolio companies have showcased on Shark Tank.
Like
Kerala Banana Chips.
Yes, I know.
Renal Project, which is a dialysis center startup. Recently a men's sexual wellness brand called Sukham.
Oh yes.
We had Mind Peers mental wellness company by Kanika, and a few others, right? And all these companies came on to Shark Tank when we funded them, and after Shark Tank, it only helped them because whether they raise money from them or not, that was not the primary
Yeah.
objective. But they were able to get viewership.
Platform, yeah. That
They were able
platform.
to get a platform. KBC's orders increased because there was a brand brand awareness which was created, right? And I think certainly Shark Tank has kind of um, given an opportunity to passive entrepreneurs, and I think has been a good catalyst in adding to the third tier, the government support, the VC and the entrepreneurs, and then the media,
Yeah.
which enabled to increase the curiosity of entrepreneurship. I
Correct.
think that is also an important element to have. So definitely, I think it's added to the entire process of entrepreneurship.
Yeah. When are we seeing you on Shark Tank?
I think as a VC we won't be there on Shark Tank because we have a very like I mentioned, we have a very cohort
Yeah.
class type of investment. So we don't typically do investments on the spot,
Yeah.
right? We are a team of co-founders, partners. We there's a process which we follow. A company comes, they apply. We evaluate the details, we call them to office, there's an investment committee process around it. So no, Shark Tank is not happening.
Okay. But please tell our viewers also something about this cohort-based approach
Sure.
that you guys have,
Yeah.
right? Because this is something which a lot of VCs don't have,
Yeah.
right? And they are more about okay, let's go step by step, like only one company or
Yeah.
two companies or stuff like that.
Right.
So please explain something about that.
Yes, no, and I think that's a great question. You need to understand where we come in. I come back to the same point, discovery fund. So bottom of the pyramid, where the first institutional check, right? Also, the length of the bottom of the pyramid is
Yeah.
big, right? So the larger growth stage funds come somewhere here. So they're doing less number of investments, but they're coming in when the companies are maturing or slightly matured, have discovered a product market fit, right? Our mission is to come in early to enable product market fit, right? And give them capital for that. And hence, quantity is also important, right? And therefore, we make investments in a set of companies at once, right? So, class 1 was 20 companies, class 8 was 25 companies, right? So, when we identify and shortlist a set of companies, 20, 25, 15, we deploy the capital upfront to them and
Okay.
give them their capital. So, it enables us to manage them in set, and that set of companies is called a class or a cohort,
Got
right?
it.
And we announce this class and cohort all together at the VC pitch stage, where they then eventually raise follow-on capital from growth stage VCs, family offices, or corporates.
Okay, that's a lovely approach, but it kind of helps you also focus more, and it
Correct.
yeah.
Correct. You're more organized. See,
Yeah.
these companies are, some of them are doing 50 lakhs per month, and some of them have launched their product recently, right? We play with both ends of the spectrums, right? So it can't be distorted. You need to kind of bring them together, create a process around it,
Yeah.
right? So it's a process version of a venture capital, but at the early stage level.
Got it. But who decides on them? Like, do they have to approach you, or you approach them, and who finalizes?
It's both ways. So in terms of we work with a lot of incubation centers. We work with a lot of founders who recommend companies, right? So we go speak with founders, meet founders. We work with every IIT entrepreneurship cell. A lot of incubation centers where companies are housed, right? And then we also have now a portfolio of 350 plus co-founders
Okay.
from the 150 companies, right? So we can receive a lot of recommendations. That's one. Second is we have an application process. There are a lot of applications which we receive. Over the last 4.5 years, we've evaluated 40,000 applications, from which we've invested in 150, right?
Okay.
So
that makes me understand that your process is very strict. Your selection process is very strict.
Yeah, I think if you do the conversion,
Yeah.
it's like 1.52%
Yeah.
selection process.
Yeah.
Yes. So, and even for that, since we're coming in at an early stage, we do appreciate and realize that the ones who did not get selected don't necessarily fall under bad ideas. They weren't maybe just not prepared. So we have a non-for-profit, in fact, multiple non-for-profit initiatives which we do at the bottom of the pyramid.
Okay.
Like founders dating. You're a single founder and you have a great idea, but we can't fund you because you don't have complementary skill set. There's nobody building a technology for you. You have a founders dating platform where potential co-founders and founders meet together. We've had, we've seen 800 plus or 1000 plus companies go through this format, and 4% of these companies have found their co-founders.
Yeah.
Right? That's one.
I think something like this government had also done recently. Like there is this train which operates.
Yes. That's been happening for quite some time. That's the Yatra.
Yes.
Yes. So that's started by Shashank. He's a senior. I'm forgetting his name, but he's been doing it for quite some time. Then the second thing which we do is Gurukul, where founders who've gotten rejected or are not ready to apply for funding, they can go through a 12-week online recorded session, which is called 100x Gurukul. They get a certificate, right? And those sessions enable them to learn more about how to sell to enterprises, build a product, common mistakes of fundraising, common mistakes of launching a product, all those nuances which only get them ready for applying,
bigger picture,
and applying and then getting the next round of funding, right? So we do a lot of these activities as well. But again, cohort based, batches based helps us manage the volume. If we are building a discovery fund and they're growing into certain metric driven companies which essentially have to reach the escape velocity as we call it.
Yeah. Okay. Now, tell me something from your personal experiences with all the companies that you have invested in and the growth pattern and everything, right? Was there any point in time with these companies where you felt like, no, this is just not happening, or maybe you had a bad exit or you had to kind of leave in between?
We've been fortunate that the process which we brought onto the table, we were able to identify good winners. And then obviously COVID happened. And we were deploying capital and managing companies throughout that phase. And we've had many winners also. We did a partial exit where we got 73x return, right? And then we've seen a small set of companies, to sum it up, I think 4 companies which weren't able to kind of do for whatever reason, because of COVID. I don't think so. We have a portfolio yet where we've had a bad experience, where we've made a bad decision in terms of, no, this was wrong, right? I think we're still early for that. Maybe I'll be in a better position to answer this maybe 2 years down the line.
Okay.
But to answer what went bad for us is our inability to get into one deal. We missed companies. We missed investing in companies. I think that anti-portfolio, as we call them.
Okay.
And that happens a lot, right? So while we've invested in great companies, we've also missed out on a few. And I think if you say what's been a bad experience, I think one of that has been that if we were able to go back in time and invest in those companies, right, which we missed out, would have been good. But besides that, I think we're still fairly early as a fund. We are growing, and touch wood, companies are growing on a certain path, and the failure rate is relatively low right now. And we don't have any big red flags right now in terms of companies becoming bad apples. So I think the only bad experience comes from the companies we weren't able to invest in.
Okay. Is there anything like, if I have to ask you, never say these 3 things to a venture capitalist, like coming from a founder's perspective, like, because there are a lot of viewers who are watching us who might want to approach a VC or who are in their early stage of startups and stuff like that. So this question is for them.
I think the first thing you should never say to a VC is, I have an idea, I need money to build that idea.
Perfect.
So never do that. You've built something, you validated it to some extent, is when a VC will come in, and that also which type of VC. That's where a seed fund like ours will come in, not necessarily a growth stage VC, right?
What do you mean by validate?
By validation, I mean you intend to make a phone, simplistic example, right? You come to us and say, I want to make a phone, please give me money. Don't do that.
Okay.
Make the phone and show us that this is working.
Got it.
Then you're raising money to mass produce the phones, right? So the validation comes from the input output of the phone, right? So that's the stage a fund like us comes in. We are comfortable coming from here. We can come here also, but this is the earliest we'll come in.
Yeah.
Not here, not an idea, right? But there are many funds who don't come in at this stage. They'll only come in at when you've mass produced it and started selling and you're generating an X number of revenue, right? I think this is what the founders should be aware of. And I think today, gathering that information knowledge is not difficult. Everything is collaborative. We are speaking right now. This is going to be accessible publicly. You do a Google search, there are many articles available, right? So gathering that information is not a challenge, right? So that's the first point.
Yes.
Second is going to a VC and saying, I'm doing this part-time. I have my job going on and I will continue to be part-time till the time I get funding. That doesn't work, right? You need to be 100% committed, right? You're requiring 100% commitment from us in terms of capital.
Yeah.
Hence, you need to be 100% committed, right?
So basically, you vouch for confidence of that person. Like how confident is he and how invested he himself.
Absolutely,
is
you said it.
Yeah.
How invested is he in his own idea?
Yeah.
That's very, very important, right? And the third thing I think is checking for the mindset of wealth creation. If the founder says, I'm full-time but I need a salary of XYZ because I left my corporate job, that mindset is a red flag.
So
because you have to understand you're creating wealth. You own the equity of the company. And wealth creation mindset is first. आज पैसे कम हैं, कल आएंगे. अगर product चल गया और बन गया and validate हो गया, then the sky is the limit, right?
Yeah.
Right. So your focus cannot be only salary per month. These three things, at least for an investor like us, are red flags.
Okay.
And deters us from investing.
Yeah. So basically, all in all, it's more or less like, okay, I have this, but so whenever there comes a but, you guys are like, no, this is
not necessarily whenever there comes a but. There are few buts which are not acceptable.
Okay.
For instance, if a founder comes, I'm full-time, I built a product, I'm not taking any salary, but I have a challenge with GTM going to the market. That's not a but which stops us. We are interested.
Yeah.
That's an interesting but. GTM is a challenge. We
Yeah.
can address that. I've done this, but my product needs more distribution. In a large enterprise, I have only one customer. That's interesting because he's tried to get to one customer. How can we help by putting our capital and getting him access to 10 customers, right?
Correct.
Those ifs and buts are acceptable. But I'm not sure if I want to work, but if I get the capital, I will start. Red flag. I have started doing something, I will, but I'm doing it part-time. But if I get the money, I will do. Not happening. I've started doing it, but I now need salary because I've left my business.
Yeah.
These are wrong motivators to begin a business. Because this mindset eventually will build up into something, boss, I can't do this. ये मेरे बस की बात ही नहीं है. मैं जा रहा हूँ 9 to 5 job करने, right? So that affects the VC because the founder, again I come back to my original point, doesn't have the mindset to pull up his sleeves.
Yeah.
And put in the extra effort.
Correct.
If a product fails, but it doesn't have a long-term view to build a business, right?
Yeah.
I think these are the biggest red flags. Again, there's no perfect way of determining this. It's the more investments you do, the more founders you meet, the more founders meet the investors. It's a symbiotic relationship, right?
Yeah.
Sometimes it works, sometimes it doesn't work.
Okay. Which is the best industry you feel currently is pretty much investable or is booming currently?
I think India is at a point where all sectors are up for grabs. Fintech will continue to remain a focus area. I believe the way we have been connected digitally, agri-tech is a very, very interesting space. We have a portfolio company called Philo, which is working very closely with farmers. A fantastic company, fantastic set of founders, and has only reinstated our belief and faith in this sector, which we believe is ever growing. So agri-tech remains a very interesting one. I think deep tech and clean tech are two sectors which are finally coming around in India, right? We've invested in a bunch of companies. In a clean tech company called Emo Energy, which is a deep tech battery coolant technology, recently raised funds, and they built out this battery grounds up. Took a few years to do R&D and then move up, right? We have another company called Wasteful Robotics, which is in plastic segregation. Great founders spent 2 years just building the robot, right? And initially it used to segregate plastic like this and this. Now it's doing. So the efficiency of the product increased. Now they've moved to the next phase, right?
Yeah.
We're seeing these products come out of the ecosystem, right? So these sectors are of interest: clean tech, deep tech, SaaS, fintech, agri-tech. Again, we are very opportunistic and sector agnostic. And the reason why we are so confident of investing in so many companies and we want to continue to do it because we believe every sector has potential. So in my view, 2024, great year for India. All sectors, whether it's D2C, from a chips brand to a coffee brand, which we've invested in, to clean tech, a robotics company, to a battery cooling technology, we've invested. From food tech, where we've invested in a robotics company which makes food, 4 QSRs, to enterprise tech, to agri tech, and fintech, which is now becoming horizontal. I think everything is of interest to us, will remain of interest to us, and I think will continue to kind of be large sectors for founders to build out in to capture enough and more market in India.
Okay. What would your advice be for the early stage founders, especially in India 2 and India 3? India 1 is still accessible when it comes to looking out for VCs and going out all there. But what advice would you give to India 2 and India 3?
I think the only advice I will give them is that don't have that inhibition or don't have that thought that you can't reach out to VCs. You build a product which works, which sells and is good, VCs will come to you. The last 45 days I've been in Udupi, Mangalore, Chennai, Bangalore, Goa, Varanasi, right? Meeting founders, and I had many other investors with me in these cities, right? So the only message to founders is tier 2, tier 3, don't worry about how you can reach to investors. You only focus on building the product and ensuring that it is working and it's a large enough market. We will come to you.
Okay.
That's the only message.
I mean, how many VCs do you get who say this, that, okay, what, we will come to you. So that's wonderful, that your approach is fantastic. Do you want to give any, 1-2-liner quote which you believe has stuck to you since so many years that you have reached to this stage that can help the viewers as well? One good thing and one bad thing, you can say. One good advice which you received, or one bad advice which you received.
So, one incident I'd like to iterate. During my founding days, my founder mentioned this to me and this stuck with me, and I think this is caused a major differentiation in the way I approach things. We started this company and we were building this product, and me and the product guy were just there should be one feature here, one feature here, one feature here, and then my founder comes in, he says, when is the customer going to get the product? And we said, we have to perfect the product. Abhi launch karenge hum. So he said, just go out and sell the product, get the feedback, and then reiterate. Like, you might be building in your perfect state of mind, but that might not be the perfect state of the product for the customer. So one important lesson I realized, and this is my message to the founders, is that don't wait for your product to be perfect. Build it to a certain level, it's called beta version, then alpha version, right?
Yeah.
Roll it out. Get customer feedback. Because if you're, again, high on conviction, you've identified the problem, you have a solution, it's a large enough market, then you're only going out with the product to get some iterations done, right? Because you're very clear in what's going to go out in the market. So don't wait for the perfect product to be built out and then go out to the market. Get a sense of a mechanism or a methodology between your potential customer and the product building team, right?
Yeah.
A feedback loop which enables the reality check of the product. You're building a next real estate plot and realizing you're building it on the moon, not Earth. There's no atmosphere. So, for a lack of better idea, right? And that feedback loop helps you get a pulse of the market, right? A pulse of the customer. And I think this is my one feedback in terms of in the euphoria and enthusiasm of building a startup. Keep this concept in mind. And biggest learning for me.
Okay. And one bad thing? Or one bad advice and you felt like, oh no.
I think the only bad advice is that, oh, don't do this, you'll fail, right?
Yeah.
I think the only thing is knowing what works for you best is known only to you. So many founders sometimes, start companies and think, नहीं उसने कहा था तो मेरे को लगता है इस करना चाहिए. Right? You don't have that mindset. If you're making a mistake, make it and learn from it, right? So that mindset is good.
Maybe it's also because a lot of people have a plan B. Like when I started, I never had a plan B. I was like, नहीं यही करना है.
No. So even having plan B, we have plan B, C,
okay.
everything, right? But that is a function. If plan A doesn't work out, what is the course correction you do? Come back to plan A. Right? Well, a lot of times plan A is nahi chala to plan B, which is a different tangent altogether.
Yes.
Right? So point I'm trying to make is that do things which you are comfortable with. Don't, and even if you're launching a company, starting out a company, don't let anybody else tell you, don't go in this direction, go in that direction. Use your mind, use your own research, use your own market research, and then do what you believe, because you will be funded on your thought and your vision by the investor, not your friend's vision, not your family's, your uncle, chacha, taus, everybody's. No, your vision, right? So the more clear you are and confident you are about which direction you see yourself, you might not have all the answers.
Yeah.
And that's where the follow-on investor will come and say, these guys might face a challenge in distribution. Okay. But if you don't know how you will, if you don't have a broader roadmap, then it becomes a challenge. So the bad advices would be that, don't do this and you saying, main nahi karta, chalo, theek hai.
Yeah.
Right?
Don't just submit into it.
Don't question things, understand. It's a great time to be questioning the existing markets. Question the markets, right? There's no product there. Is there a big enough opportunity to build a product over there, right? And I think that is important to have.
Okay. Thank you so much, Mr. Shashank. It was a wonderful session with you, and I hope our viewers, our listeners have for sure got a lot of great insight out of this podcast.
Thank you so much for having me and giving me this opportunity, and I wish all the viewers to fantastic 2024, and to all the aspiring entrepreneurs to continue exploring their dream, because there's no better time to do that, and I think such platforms bridge the gap between founders and prospective builders, founders, investors, and I think there's so much collaborative opportunities which emerge out of these platforms. And thank you so much for having 100x and myself here. So thank you.